Depending on market conditions, the stock could potentially be better than the company.
There's a million reasons for an insider to sell a stock, but only one reason to buy, and that's when they think the business is undervalued.
Interest rates have risen. It makes something like a bond comparatively attractive.
Guys, I think I also have to express probably the biggest factor for success. They have Ryan Reynolds as one of their ambassadors here.
All right, what's up, everyone? Welcome back to the Beyond the Edge podcast. This is episode number 2. I've got my friends and co-hosts here, Peter Palarchio, Declan, Mr. Fundamentals, O'Flaherty. I'm Kevan, Small Cap Kevan Matheson. And today we've got a few things to talk about. We're going to kick it off with going over the contents of the Sunday snapshot coming to your inbox this Sunday. We've got 3 articles we're going to dig into. Then we're moving on to a quick edge occasional segment where we're going to talk about rising interest rates, why that actually causes certain assets like the stock market to fall, generally speaking. And then finally, we're going to conclude things with a light discussion around a stock that Peter, Mr. Trend Tracker, has found for us. So let's go. Guys, you ready for episode number 2?
Yeah, let's do it.
Absolutely.
Okay, let's get into it. Okay, Mr. Fundamentals, you put together the topics for the snapshot. So first, let's talk about a company that I love to hate, Robinhood. Now, I don't know if anybody has watched that recent movie, Dumb Money, but that if you haven't, that's going to fuel you with a decent-sized helping of hatred for these guys. How they handled the whole GameStop situation was pretty brutal. But that's not the main topic we're going to start with. Where we're going to start is that they've recently expanded their crypto trading platform, I guess, to Europe. So I'm going to kick this off with 2 questions. Question number 1 is, what do we think about the move to expand their crypto business to Europe? And number 2, let's just talk about overall thoughts on Robinhood as a company, as a stock to own. Either one of you want to kick this off, and then I'll chime in with my thoughts?
Yeah, Declan, let's hear what Mr. Fundamentals has to say.
Sounds good. Yeah. I mean, the big thing is crypto's kind of on the rise. It's returning. It's in some sort of bull market right now. And a lot of, let's say, the weeds have been cleared from the market, whether it was the FTX scandal or even Binance more recently. This is Robinhood's latest play to try and capitalize on that market and possibly the long-term trend. The real question from my end as to Robinhood is, how are they going to differentiate their platform from other exchanges that offer crypto services? And will they be able to create a competitive advantage, or will this just become a more commoditized product in the long run? So that's kind of where I'm at with it. But yeah, I'd love to hear your guys' thoughts.
Would not stealing your users' money be a good point of differentiation, or what?
Yeah, there we go. Let's go.
I think you could start right there, and maybe that would be interesting, and not follow some of the other people in that space, what they've been doing. I think, Kev, I don't know about how the movie portrayed them, but I think even with the GameStop saga, it was a bit of a black swan event on how that happened, and their platform just wasn't built to it, and it's not like they were doing anything unsavory. Can you expand a little bit on that as to why they were even put in that situation?
Well, the big dirty that they did was that basically, I don't know if it was at the peak or near the peak, but it was right in the heyday of Robinhood, like manic buying. Mm-hmm. They actually removed the sell order option for a period of time. So if you saw your value, I forget, oh my God, Roaring Kitty, he put in $50,000, I think it was. And at one point it was worth, let's say it was like 20 or 30 million bucks, like just madness. I still can't wrap my head around it. But there's a certain point of time where people started looking to sell, and Robinhood physically removed the sell button from what is it? They removed the buy button. And though they won't admit it publicly, apparently there was a lot of pressure coming from Citadel Securities and other hedge funds that were just getting absolutely smoked from this. So yeah, they didn't remove the buy button. They removed the sell option. They removed the buy option so that they wouldn't cause these short funds to lose any more money. Like I said, this wasn't like publicly admitted to, as far as I understand. I think it was a lot of backroom dealings. But I mean, you just can't do something like that in a fair market, in my opinion anyways.
Yeah, I'd have to agree. So if there's some, customer disconfidence, and then you're moving into crypto, which is incredibly volatile, this could be an issue because, that GameStop was about as volatile as the equity as we've seen. Crypto is obviously a lot more volatile with 24/7 trading and volatility. So I think, it's still a tough space, but I think investors everywhere, like we're all small cap enthusiasts. Not every brokerage offers small cap stocks. So, I think there is a little bit of a buyer beware when you're, choosing your brokerage as well. And how many other offerings are there in this space that are, trustworthy? That's an interesting question.
Reputation is huge, and I think that's really what they're trying to establish here as a company. And as Kev mentioned, like these past stories are kind of maybe a chink in their armor, and it's really trying to establish themselves in this market. Now, one thing to keep in mind too is a lot of controversy surrounding crypto has largely been located in the US, and Robinhood with this new trading platform is initially targeting Europe because it has more favorable conditions. So how that plays into it, and if they can really establish a strong presence in this market that maybe allow it to propel to new heights is a big question. And so curious anyways.
Yeah, I think, there could be an interesting advertising campaign behind it, like not for your everyday short squeeze investor. That could kind of get them going again, like something along those lines. So I don't think you have to be built for short squeezes. And that's interesting just about the more favorable conditions in Europe as, crypto adoption is still, I think a huge opportunity as a lot of everyday people seem to kind of be more and more interested in it.
And I mean, as an enterprise, the idea of increasing revenue by expanding beyond equity trading into other things, in this case, crypto trading, like you look at back here in Canada, WonderFi, they did the opposite. They started as a crypto trading platform, then they expanded into equities and sports betting as well. So it's kind of the same thing, but in reverse. Makes sense. Here's, in spite of my hatred for Robinhood, I just didn't like how they handled that situation. I thought it was extremely unfair and biased for the retail investors that got screwed from that. One thing I will say is digging into the asset, like into the balance sheet and the income statement, I found something that confused me and interested me at the same point in time. So for example, if you look at, let's say, the market cap, $10 billion, I think they have something like, I believe it was $1 billion and a bit of debt. So enterprise value jumps up a little bit from the market cap. But then when you look at, for example, net assets, total assets minus total liabilities, $7 billion, like pretty significant. But what confuses me the most is that when you look on the balance sheet and you zoom in, it said $6.3 billion in cash and cash equivalents. Now, one thing that maybe you guys help me wrap my head around, because I am confused, if a customer puts a deposit into an account and their cash sits there, let's say Robinhood does or doesn't reinvest it, does that show up as cash on the balance sheet? If yes, it would have to have a corresponding liability. I couldn't find any obvious matchup. So is that $6 billion cash just like working capital cash for the enterprise, or does that represent balances of customer deposits? If balances of customer deposits, then this is a whole different discussion. If that's truly 6.3 billion just cash, plain and simple, then all of a sudden the enterprise value of this thing is like $3 billion and like nothing. Right. So I need to understand that, because that could totally change my thesis on this company, and I just haven't had enough time to dig in.
Yeah, we might want to do a quick look that up, because I think that would be under their assets under management, and they have to have more than $6 billion for their size.
They must.
Yeah, they must, right? That's not exactly a big bank in the banking world. So I'm assuming that they have more than 6 billion assets under management, and then some more digging into those cash and cash equivalents. Yeah, interesting play that they're only at around 10 billion market cap today. Yeah. Losing money though. So, how's that looked upon? The tech sector has taken a big hit. Investors overall are looking for safer bets in, the past 12 months as maybe economic conditions change, hopefully in 2024, late 2024, and we could see a bit of a bull run. Is this something that you guys might be interested in later in the year?
Yeah, just going back to Kev's point too, if it follows any structure similar to like how a bank operates in terms of deposits and withholding, then it should be under like its short-term liabilities. So that's where you may be able to find customer deposits themselves. But again, and then going to like Pete's point too, I think the big thing here is, these are very volatile assets. And so as consumers start to, I believe the app is coming out in the beginning of 2024 or something, but as consumers start to deposit, if we do face similar circumstances like we did say in 2022 with crypto, are we going to run into similar issues that happened at Binance, Coinbase, or these other brokerages where essentially they ended up deciding to almost do exactly what they did with the whole GameStop scandal, where they withheld traders from being able to make their moves? So that's a real test on them as a business, and as a company that already hasn't made much money or isn't really even profitable. Like, how long can you sustain that and grow your business before you really have to dial in and start to build a business model that can be profitable and endure for the long run? And that's really my hesitation with the company is they've there's an old Warren Buffett saying that you can lose your reputation in an instant, and or it takes a lifetime to build a reputation, and you can lose it in an instant. And this is one case where they've already said they have one strike. So if they keep doing it, like, how do you know? How do you know as a consumer? How do you know as an investor?
I mean, for me, that one strike is like a critical hit of a strike, because as a brokerage, your job is to facilitate buying and selling in what's supposed to be an unbiased way. So the moment you dictate what a person can do with money they've entrusted you with, I think you've failed your job completely. And for me personally, I would never trust Vlad or Robinhood ever again with my deposits. And I can't help but think there's going to be a lot of people with a similar view. So for me, fundamentally, I feel like it's going to take them a long time to build that trust back.
Yeah, I'd have to agree. I mean, how much should we have trusted guys that built a lot of their wealth by having a faster internet connection to begin with? Like, that was kind of like their initial arbitrage opportunity that they found. That's not necessarily a true cloud investor as much as an opportunist, right?
True. Yeah. Reading for the Edge audience, Flash Boys. Excellent book, and you'll understand a lot more about high frequency trading. Really good read. So, okay, I mean, I don't have much further in terms of Robinhood opinion. I want to understand. You're right, Pete. You nailed it there. It's $6 billion. Obviously, that's not their total assets. So, total assets under management. Maybe it's a fractional reserve kind of thing, just like banking, where that $6 billion is 10% of the amount that's trusted. The rest is reinvested. Because I know their primary way of making money is interest on deposits, and then payment for order flow is about 5% of their book, of their revenue. I have issue with that as well. We can get into that, but I personally don't have any more meaningful views. I see it as a long-term. I'm not thrilled in this company. If they were able to build trust back, fine, there's a positive, but it's going to take a lot to convince me, unless, of course, there is this crazy discrepancy with their enterprise value being something like $3 billion, just so low that it's worth a shot. That's the only thing that would interest me.
Yeah, it'd be interesting. I mean, on their, they are doing billions in revenue, a little over one and change, right, Declan? Yeah, that's right. Yeah, I think, depending on market conditions, the stock could potentially be better than the company.
Yeah, exactly. That's kind of where I was going.
I'm kind of on a similar boat. I think this would be a hard no for me. Really, they just, this market and operating within the exchange market itself is there. It is to some extent commoditized. Like, you can choose many different brokerages, and there are different features, maybe different markets you have access to. But for the most part, the competitive advantages that these businesses have are quite weak, fundamentally speaking. And so from that standpoint, as well as just a history that is kind of murky and not necessarily ensuring trust between all its stakeholders, gives me reason to just doubt its investment prospects overall. So that's kind of my stance on the company.
Yep. Fair. Okay. Well, guys, why don't we move on to the second stock we're going to talk about? There was some news out of Medifast and LifeMD. So basically, these guys have a partnership where their two businesses, the way they see it, are going to be complementary to one another. Medifast, a brand you guys might be familiar with. What is it? What's it called? Optiva?
Optavia.
Octavia.
Yeah.
So Optavia, that reminds me of something classic, like from Weight Watchers. Jenny Craig, seems like they're in the same world where pre-portioned, calorie-restricted meals. You have 5 or 6 of these meals a day. You have a personalized coach. There's the Optavia program. There's Medifast. Then there's LifeMD, kind of this more new age approach to telehealth. But then they also layer on these GLP-1 drugs, which are obviously very popular. It seems like everybody wants a pill to fix their problems rather than exercise or hard work. But it just shows in the numbers that it's working. So they see this as kind of a 1 + 1 = 3 partnership here. Both stocks were down, actually. LifeMD, I think it rallied for a moment there. Ultimately, both stocks wound up down. Why don't we kick it off by saying, first off, what do we think about this partnership? And then let's dig into, do we have any opinions on either of these stocks? Pete, I know you've got a lot of opinions on the GLP drugs. Do you want to kind of kick it off?
Oh yeah, I think it's super interesting. GLP-1 has been an absolute game changer in the weight loss world, originally prescribed for type 2 diabetics, which is, a bit of an epidemic on its own. And it's been kind of a market that has seen two companies, well, really one company, Novo Nordisk, own it with Ozempic and kind of the suite of products with Wegovy and Rybelsus. And then the new player in town in this is Eli Lilly. And, Ozempic has crept into one of the top 20, Novo Nordisk has crept into one of the top 20 market cap companies in the world by size. Wow. So, and Eli Lilly's there too. And you're seeing institutional investors absolutely flock to these things. This is something that the consumer base is saying we want and we like because of its success. Now, I think you kind of have an interesting world that it was initially created for type 2 diabetics to regulate insulin and your blood sugar levels, and the byproduct of that has been weight loss. Obesity is one of the largest, contributors to chronic disease in the world, and if you can have a pill to reduce your pill or an injection to reduce your odds of getting a chronic disease, or just look better, people are going to do it. Yeah. It's a heck of a lot easier than going to the gym and dieting.
Mm-hmm. Yeah.
So it's a huge market for sure.
Yeah.
Huge market.
Yeah.
Unintended. I saw a stat that nearly half of the U.S. adult population is obese.
Wow.
It's like high 40%, mind-boggling. And it's not even the fattest nation in the world anymore. I think Mexico has even topped it now. And kids in the U.S. under the age of 18, it's, 19% are obese. Wow. Kids. Yeah. Brutal. Just tragic.
Nutrition's, entirely broken across many places of the world. People are moving less and eating more. And I think even for a doctor, it's probably easier to prescribe this than anything else. So I think the GLP-1 market, unless bad side effects come around, which are always possible, is likely here to stay for a while. And it's like, how many new entrants are going to enter, right? And Declan, I think a little bit in your research on this, is Medifast, are they coming out with a GLP-1, or are they just partnered with the ability to prescribe now?
Yeah, so with the partnership with LifeMD, that's how they're actually going to be able to access this market. And, as you said, Pete, these GLP-1 drugs have been extremely disruptive to, say, Medifast business model, as well as other players within that market space. And that's because, their whole business is built around these new nutritional products and then the coaching, but it doesn't necessarily offer as effective as a solution as something like Wegovy can have and bring to the table. And so by Medifast partnering with LifeMD, now they can tap into this market, and they may not directly benefit from all the revenues that these drugs can bring, but they still are going to get significant upside from these drugs and bringing it into their offering towards their clients and patients. So yeah, that's kind of how the partnership benefits. Anyways, my interpretation of it. Yeah.
Yeah, that's interesting too, because I mean, from a margin perspective, if they're, the ability to prescribe these, which I've seen a lot of wellness centers being able to prescribe these. You don't have to be a weight loss clinic. People are using these for, a bunch of different reasons in the weight loss world. There is no necessarily set guideline on pricing that I'm aware of also.
Yeah.
So I think that's interesting, that if you are a type 2 diabetic, we're, up here in Canada, and that would be covered as a diabetic drug. But in the weight loss world, I think these centers are able to kind of charge what they want for some of these things, and, potentially have a pretty healthy gross margin on some of these.
What happens when you stop taking these? Do you gain the weight back, or is there some lasting effect?
Yeah.
So I think we're going to get, Andrew Huberman on this and Dr. Peter Attia to fill in. They have their own opinions.
Yeah.
Well, what are their opinions? Do you know roughly?
Yeah. So, I mean, to paraphrase, most people who are not obese, those guys are saying you shouldn't be taking it. This isn't the drug you take for 10 pounds. They've kind of said they have their own independent studies on it. I think that, if you're someone looking to lose 10 pounds, this probably isn't something you should be taking. And it's not indicated that way. It's indicated for people who have, serious issues with insulin resistance. And that's why it works. And that's, a huge contribution to your metabolism, right? Yeah. And that's really important. So those guys aren't advising it for people to lose 10 pounds. And unfortunately, vanity is a real thing, and a lot of people are going that way. So interesting to see how that should be prescribed by potentially, I don't know what type of on-site physicians these places offer, but that will be an interesting play.
Yeah.
It sounds like that's where LifeMD comes in. So they've got the clinic network and the ability to prescribe and the telehealth platform to supplement the kind of more, I don't know if you want to call it traditional or holistic approach from Optavia and Medifast.
Yeah.
But okay, so Declan, you own the stock. So there's a disclaimer, you own Medifast. Let's talk about this, because I'm not surprised you own it, because Mr. Fundamentals, I look at it, price to earnings ratio 6 times. That's low by basically any standard. They seem to be like you could argue that it's undervalued. Like, I get that.
Yeah.
The kind of red flags that come up for me is that their kind of growth, if you will, is kind of trending the wrong direction, right? Like, if you look at, good for them, I would say over 2021, their revenue jumped like 50%, which is great. Which is not surprised. Everyone was at home, lockdown. Anyone who had a subscription box offering seemed to do really well. So that's not surprising.
Yeah.
2022, it held in fairly flat. Then their most recent revenue, or the most recent report that came in, showed a pretty monster drop in revenue, down actually 39.6% to $236 million from $390 in the same quarter of the year before.
Yeah.
Big reason for that is that the number of coaches that they have has actually dropped quite a bit as well. So two things jump at me right there is, one, revenue's dropping while number of coaches representing you drops as well. It kind of makes you think like something's broken, like it's not as popular, something's not working. So my question is this a great value play that you're buying for pennies on the dollar, and partnerships like this with LifeMD are going to bring it back to life? Or are we trying to catch a falling knife and we're just going to cut ourselves as we try to catch it on the way down? What do you think?
Yeah, no, it's a great point. And I think, to provide some context too as to why their revenue has dropped is, first, there really is no denying that these GLP-1 drugs are shaking up the market big time. This is a quick and easy solution that people can hop on board and immediately see results. My initial pushback from that was that, okay, well, in order to really sustain your weight loss, you're going to need to build strong habits. And that's a big part of Medifast business model, is through the coaching, they want to build a life enduring habit based model. But the catch side of that is these GLP-1 drugs still exist. So through this partnership, they've kind of essentially, like, management has said, you know what, we can't beat them, so we're going to join them kind of and take advantage of this market the way they can. And they did some research with their customers, asking them about the drugs themselves and whether they would want to use them as part of their program as well. And about 50% came back saying that, yeah, we would want to have this on top of what we're already doing with the company. So that's one side of it. Okay. The other side is, this offering and what they produce, it's not cheap. So their plans usually come around $300 a month, and with inflation being high, costs just generally being tougher, this is one of those top of the list purchases that people will probably drop if they can't afford it, or they need to, cut back on spending in general. So those are kind of the two main reasons as to why the business itself has, seen a decline in revenues. But I think what really stands out to me about this business is, like you said, the valuation looked really attractive. Two, they have pretty good amount of cash on their balance sheet. I think they have about $150 million and zero interest bearing debt. So, even if things do kind of collapse, let's say in the short run, and they're definitely taking a hit right now, they're well positioned for this growth. And then, just one more thing actually from that news report that came out from Medifast is they're actually cutting their dividend. And so on initial impression, a lot of the time when you hear that from a company, you start to think, oh no, like they're in trouble. The business is in a situation that like they're kind of in code red. We need all cash on deck. My kind of counter argument to this, and time will really tell if it is true, but management's kind of reasoning for this is, what we need to be more capital efficient and allocate towards that growth. And so they've really started trying to grow the business internally rather than necessarily paying out that excess cash to shareholders. So I think it's one of those plays where, it's getting tested and challenged right now, but management is acknowledging the headwinds in its direction and trying to make the most of the opportunity and better position itself and build a business that will be able to endure with this new reality that is, there's a drug that makes life pretty easy from a quick solution anyway. So those are kind of my thesis on the business and where I stand with everything.
Interesting. I mean, first, I agree and disagree. And the part that's interesting is for a sub $1 billion market cap company to pay a dividend ever, congrats. That's amazing. That's not something you see every day. Yeah. And to have consistent net profit, again, another round of applause. That's not something you see very often. So I'd say good for them from starting from a place of strength. Anytime a company does cut a dividend, whether it's for the right reason or wrong reason, it is red alert. Something's wrong, and they no longer have excess cash for shareholders. So the question is, are they doing the right thing with it? It sounds like it. I mean, it sounds like the business is clearly under pressure, so they probably shouldn't be paying a dividend. So good for them for having it in the past. Probably good for them for cutting it to focus on the right thing. I'm very curious to see the terms of this deal with LifeMD. How is revenue shared? I don't know. I'm very curious to see how it shapes up, but I get it. It looks like ultimately it probably will be the right move. We'll see.
Yeah. I think interesting for me is like on the trends, adopting to overall market trends is something certainly you want to see the company do. In terms of them with a declining user base, that's obviously a concern, whether that's a greater macroeconomic trend, which kind of Declan referred to, is likely true that this is something you might want to cut when budgets get tight, especially if it's not working as easily as taking a pill or injection.
Right. Okay, Mr. Trend Tracker, do you know overall like demand, interest, search volume, etc.?
Yeah. Well, in terms of GLP-1 or them specifically?
GLP-1. When you say GLP-1, like Wegovy, that's under this classification. That's one example.
Basically commonly referred to as Ozempic. Well, you can't get the stuff right now. There's a shortage of it because of how insane demand's been.
Wow.
There is a bit of a shortage, and that's Eli Lilly, who's also come up with their product. This isn't the easiest thing to get this quarter because of the unprecedented demand, and those Novo Nordisk in particular had an absolutely record quarterly earnings on their last report. So this is something that consumers want. I think in this side, if they're prescribers, you're creating an easier avenue to get this virtually than going, let's say, to your physician or your doctor, which you might not be able to do. Maybe this is something, I don't know how they are allowed to potentially prescribe it, what they need to do for weight loss, is it BMI or anything like that? But this is, it's pretty breakthrough stuff that's going to be here for a long time. Very quickly has to do with your overall insulin resistance. Previously, to treat type 2 diabetics, what they were doing was giving them more insulin. Type 1 diabetics need insulin because their body can't create it. Type 2 diabetics actually have the opposite problem. Insulin isn't working enough, and then they can't create enough due to the fact of how their body's functioning and metabolizing food and energy. So eventually, if you keep injecting yourself with insulin as a type 2 diabetic, you're out of options. This is before that. So that's why it was such a game-changing, drug for people to take. And the overall adoption has been huge.
It's fascinating because, okay, then you look at LifeMD and they're kind of like a different story where Medifast may be a great value play where, revenue has dropped, but they're still they have net profit. They used to have a dividend and they're trading at a pretty low, 6 times price to earnings. That's low pretty much by any standard. And then you see LifeMD that maybe they're on the better trend. They're on like somewhere where the tide is rising versus the opposite. And you look at them, and from 2020 to 2022, I saw that they actually grew revenue about 3x, much smaller base than Medifast, but growth and significant growth. Like they're doing over $100 million. So like they're, real company. And then at the same time that they've grew revenue 3x, operating costs grew 1.5x. So it's like efficient growth. And then you look at the net loss, they don't have profit. It's still a decent sized net loss, but it's trending the right way as well. It's decreasing, and projections for this year is that it'll decrease further. So what's the better company? The company with worse current fundamentals, but on the rise and in the right market, versus a company with better current fundamentals that's currently on the decline. I don't know. I don't have an obvious answer for that.
Yeah, it's
I know Mr. Fundamentals thinks.
Yeah, it's a great take. And I mean, to your point about LifeMD, I don't know as much about the business, but one thing that was really promising is, again, you look at the CEO and the founder, and he owns, I think it's like 7 or 8% of the business. And insiders have been buying up the stock over the past year, like hand over fist. And so, those are always good signs because, again, there's a common saying that, there's a million reasons for an insider to sell a stock, but only one reason to buy, and that's when they think the business is undervalued. And so in this case, when those guys are putting their money where their mouth is and taking conviction in their own company, you can always be impressed by that. So something to keep in mind anyway with LifeMD.
I think that's like super interesting, because I think what would be really interesting for our viewers is to see how are users doing this. And if you're a company that has an online portal and that's how people are finding out about you, we're able to kind of look at that. And I think that's a huge edge for our podcast. And we want to show how users are using this and what's happening. And I think, this is an interesting partnership because we have one company that is trending the right way. So when we look at LifeMD, and we're looking at some of their overall search traffic across the world right now. If we look at November 2023, we're only halfway through the month of December. So, we can take that out. November 2023 was a peak month of user interest and website traffic and search for them. And we can actually see that they've definitely turned on a little bit of advertising too. These people are definitely in, and they are definitely interested in getting more users, and people are responding to that. However, we kind of have a tale of two companies here, because we see the opposite when it comes to Medifast here. We see Medifast, which kind of had peaked, over a year ago. Obviously, January, very good time. But if we kind of see that, they were good for Q1 last year. And, I think we can understand what happens when, people have their new year, new you. But it's been dropping off. So I think we need to see them really bounce back in kind of January 2024 for this to pass all the trend trackers tests.
That's really interesting. So what you were just showing us there is that searches to Medifast are basically on the decline, and it's the opposite for LifeMD.
That's right. Yeah. And this is real time. That was worldwide data, and you cannot become an online customer without visiting their site. So this is kind of something I definitely put in my toolbox when evaluating companies and stocks.
That's really interesting. That's really interesting. I'd be curious to see what other trends we can find there over time. But I mean, that's like an interesting leading indicator, right? Just like you said, you can't become a client if you don't go to the website first. If a ton of people are going to the website, there's probably a lot of interest, probably a lot of new customers. Maybe that becomes like a fairly relevant leading indicator for financials. So I'm really curious to see how that pans out. Maybe we stitch back to this in 6 months and go back to you cutting to it. And I'm really curious to see how this plays out. Okay, so guys, we're still got lots of topics on the agenda here. Medifast, LifeMD. I think we kind of did that one as much as we could. Let's move on to one final. We'll talk about a mega cap for this one. To the audience here, we do still focus on 10 billion market cap and under, but there's the occasional headline that's interesting enough that we like to bring a large cap into this. So Netflix, $200 billion market cap, very, very large. They announced, they actually showed their most viewed titles over the course of the year, which apparently there's been pressure for them to do that. This is the first time they've ever done it. Just a generally cool thing to look through. There's a few key things. The only thing that really, really stands out to me, and then I'm going to pass it off to you guys because I don't have many opinions on this. It's just that, what's the number I have here? It's 55% of Netflix viewing came from Netflix produced titles. So majority of it, that's got to be bullish, because that's the holy grail, because not only can you don't have to worry about licensing rules because you own the content, you can produce it and distribute it worldwide. Unlike licensed titles, that's very different. Some are allowed in Canada, some are not, etc. So I'd say that's really bullish. Overall, I'm just not fired up on the business model because there's just so much competition in the streaming space. They're a $200 billion company already. Do I see them going to $1 trillion? Not really. I just don't see what would drive them there with all this competition. For the first time ever, I canceled Netflix because I have so many other streaming services that I kind of want to get caught up on. I feel like I've done enough Netflix for now. So I personally just am not a bull on the stock, though I do think it's really cool and interesting that they released this data. And those are my views. That's all I got.
Yeah, no, it's super interesting. I think I share a similar viewpoint to you, Kev, in terms of just like investment wise, but I do have to admit I was kind of a Netflix hater as an investor last year. They went under fire a lot and Disney really kind of made its mark for a while, but I've been proven wrong. And I think what they've been able to establish is they are a leading player in this industry. Now, maybe the valuation not be as ideal in terms of from an investment standpoint, but the business itself has built a reputation around producing content, like you said, that is able to garner a lot of respect from audiences. And I think what they do better than perhaps any other streaming, like video streaming service aside from maybe YouTube, is that they really leverage that data and the insights they get in order to make content that drives user attention. And whereas a legacy business like Disney may be in the mix and of course has a lot of goodwill, a really strong brand, they're creating it on a completely different business model. And so I think, while Netflix had struggled last year and took a bit of a hit, what they've been able to demonstrate is their business model is a lot more effective and resilient than I first thought. So a bit of a shocker there.
Yeah, I think there's a few interesting things here to talk about. Is the why? Why did they release this, right? And I think there was, some other news as to why they weren't in the past was that it gave kind of showrunners, writers, actors more leverage to negotiate bigger deals themselves on this Netflix produced content. It's like, hey, if we're responsible for 50% of these eyeballs, like we're going to ask for more money next time.
Yeah.
I don't think that's why this was released. I think this is a signal to potential shareholders and other investors that we are getting in the ad game. And I think they have talked about that for some of their lower packages or potentially free package. And I think that makes the potential of a potential market cap much higher than 200 billion if they do that. I think you have to look at, Kev, like what makes $1 trillion company to you right now,
Great question. I guess I just need to understand the growth story. Netflix at like a price to earnings of 49.50, so definitely not cheap by any standard. So they have to grow a lot. And I guess for me, I just don't know where that growth comes from. You might be totally right with ads. I can't say I have any expertise on that to really weigh in.
I think when we look at one of the world's biggest companies by market cap in Alphabet, the lion's share of their revenue is through advertising, and why they get ad dollars is because it works. And why does it work? Because of data. And why is it data? Because data is the new oil, right? Like that's really what we have to realize going into 2024. And if they're hinting towards some type of advertising and those eyeballs are there, that's worth a lot of money. And that really just depends how they're building that internal infrastructure. If they're willing to kind of share some of those metrics with advertisers, that's worth a lot of money, guys.
That's
so I wouldn't be, yeah. And then the other thing is, I think in terms of business model, they are also expanding beyond the digital streaming world and taking a page out of Disney's book and getting to brick and mortar locations. And I think that's a really interesting play because that will definitely differentiate them. Yeah, I think you guys have to remember that this is super interesting to me that they released what was viewed. And I think it's signs to some type of ad network. And then the other thing is taking a page out of Disney's book. And now that, look, hey guys, 55% of the reason people watch us is because of what we create. Well, Disney created their highest revenue generators, and profit centers out of theme parks. So I think that's really interesting. Disney made a lot of money off theme parks before they ever put anything on a streaming service.
Yeah, that's true.
No, you bring up some, or sorry, Kev.
Go ahead.
To jump in, yeah. So you bring up some really good points about the advertising, and I think there's definitely a market for it. I guess my question back to you is really how many users that currently have it will stick to a traditional system where it's just a subscriber base and they opt for complete no ads whatsoever, and those who opt for the cheaper option. And then, if they start to really lean heavy into this advertising, will this cause more consumers to switch? So just curious what your thoughts on that, because, there is a lot of optionality out there.
I think people are okay with watching videos with pre-roll advertising that they can skip. The only thing that I don't love is when you have Netflix content budget versus a competitor like YouTube that pays
zero.
What's their content budget? It's
Right.
if people view it. They don't pay to acquire content, and they have guys on their platform like Mr. Beast who have hundreds of millions of subscribers on their own. He has over 100 million subscribers on his own.
Yeah.
He's his own content factory, and they don't pay a cent. Advertisers pay him to do it, and they do a rev share. So will you ever match a model like that without having a self-service content creation platform? I don't know. I don't know if that's on their radar.
Right.
But I think there's definitely a large group of people out there that are willing to hit skip on a 5-second ad and stay a member and potentially save some money themselves.
Yeah, well, okay, here's what I'm trying to figure out. So there's 200, I just looked it up, 247 million Netflix subscribers. Then there's 8 billion people on the planet. I guess what I wonder is, I'm sure there's endless demand for free Netflix plus ads in most of the world. Yep. I would agree with that. The thing I wonder is who's got good enough internet infrastructure to even stream and even have the option. I don't really know. Rural areas, is 3G sufficient for non-buffering streaming? I don't think it was. I can't even remember back then, but I don't know. So does that impact demand?
That's a great point. So if their board's listening, write Elon Musk a check right now and get Starlink going to cottages in Canada and other places for sure.
Right.
But I don't. The overall upside, you gotta. It's in the billions that have access to streaming worthy internet for sure.
Interesting point of Starlink. Something like that could change things dramatically.
One more point on it is, Pete, you brought up another good point just about how in this market, they really have to, I think what differentiates these businesses from a content standpoint is how much they invest in it, obviously the network that they create. And so how big can you get in terms of being able to create these movies, and is that scalability an issue from that standpoint because of the fact that there's just so much content out there? And so how do you really optimize to create content? And to be fair, Netflix has done an excellent job of this, but just be able to do that time and time again come out with hits and be able to continue to generate that user attention without it failing over time, or faltering over time. So curious anyways.
So yeah, I agree. And that's why I felt at the beginning Netflix was really trying to have a bit of an HBO model. I think if you go back and look at HBO, they were home box office. They were movies at home, right? And then they got into the content business and produced some of the greatest shows of all time. Sopranos #1 for sure. Don't argue.
Entourage.
Yeah, so I think that was what they were doing for a while, but then somewhere along the line, that might be a hard model to say, okay, all these content things. And my biggest critique of Netflix is I don't think they leverage data as good as they could. So that's my critique. That, guys, I don't know, I'll ask you, how long does it take you to watch something on YouTube to decide what you're going to click on?
I usually go to YouTube with a purpose. Like I'm looking at how to hard boil eggs. And
how long? Yeah.
It takes me 2 seconds to find a video that's relevant.
Yeah. And how long does it take you to watch something on Netflix?
100 hours to watch one. You flip for 2 hours. Yeah, it's awful.
I will spend 20 minutes surfing Netflix to find something to go to sleep for 15 minutes.
Right. Find something you don't even really want to watch.
Right, exactly. Maybe we need to step up our VPN game and start tapping into American Netflix.
Right.
But I do not think they leverage data as good as they could. And that's why I'm actually a little bit bullish on this, because what YouTube recommends to me, fantastic, interested all the time. I don't even need to subscribe to people, right? What Netflix recommends to me it's okay. Yeah. So yeah, it's very interesting, Declan. Very difficult to predict if they're going to be putting out banger shows all the time. Yeah. But yeah.
Just like it is a really, big point that you bring up, the fact that the feed doesn't necessarily fit to what you want, or maybe there's not as much options available to actually meet that recommendation. So anyway, something that I didn't consider, and something now I will be taking into account when I'm looking at businesses in this market.
One thing I'm looking at here is, forget what I said about areas of the world that are too rural to have it. Let's just ignore that for now in the Starlink upside. US 300 and something million, Canada 40 million, Europe probably similar as a collective is at 300-400 million. I'm guessing it's about there. China probably not relevant, but maybe Japan. I don't know what the population of Japan is, but it's got to be substantial. So even that right there, we could easily soft circle 1 to 2 billion people that we know have the infrastructure. And then you look at 250 million people subscribing. Okay, there's clear potential for an ad-based, free or cheap subscription. So I can see the upside there, but I can't help but feel like that may be already priced in, considering they're at a 50 times price to earnings. So I'm curious. I am curious. I don't know. Let's see what happens.
I'm adding it to the watch list on my end. I'm mildly bullish by this. I think that's a good signal to a trend tracker. I have to, I don't think this crosses Mr. Fundamentals list though. I don't know. What do you think?
Yeah, I think you got it spot on right now. To be fair, I do really admire the brand itself and a lot of features or aspects about the business. So I think it would be on the watch list, but like Kev mentioned too, the valuation right now is a real driver that just kind of makes me hesitant to put my money into a business like this at this time. So something I'll keep watching, see if, like you said, a lot of these investments into advertising come to fruition, and if things pan out, maybe my mind will change. So yeah, that's my hard stance on it anyways. Yeah.
Love it. Okay, well guys, let's put a rest to Netflix. And let's move on. Another segment I wanted to have today, we can go through this one fairly quickly. I think introducing more education to the channel is important. So let's do a quick little segment here about rising interest rates. I think it's generally well known that rising rates are negative for pretty much all asset classes outside of, ultimately if you're investing in a newly issued bond, you get a higher interest rate. That's good for you. But for everyone else, it basically sucks. So why don't we burn through a quick educational lesson on why do interest rates actually harm, rising interest rates, why do they harm the stock market? I'm just going to blast through a really quick high-level summary, and then we can kind of share any other viewpoints we may have. So generally speaking, when rates are low, money's cheap. People, they buy and they finance houses and cars. They rack up their bills. They spend more on restaurants. Money's cheap. It tends to slosh everywhere. More money going into the economy generally heats things up, increases inflation. Inflation seems to be the arch nemesis of central banks, and they'd rather see a recession than persistently high inflation. So in order to cool things down, they boost interest rates. Interest rates go up. Now all of a sudden that car you want to finance, that mortgage you want to buy, you take on, that becomes a lot more expensive, and it's going to push a lot of people out of the market. When people are out of the market, not investing, not taking on these assets, things generally slow down, inflation slows down, central bank is happy. So that's kind of the fastest summary that I could possibly give on something like that. Obviously, where we're at now, interest rates have risen. It makes something like a bond comparatively attractive, because if you can now get a corporate bond that's far lower risk versus like at the equity market, and it's at a higher interest rate now that it's starting to look compelling, well, money's going to come out of the equity markets into the bond market. So again, very short summary of that, but that's what we're seeing now. So that's what's happening. I guess the question is, where do we think we're at in this cycle, and what do we think is going to happen next? Do either of you guys want to kick that off?
In my opinion, this is peak interest for a lot of reasons. One, what you basically said is this is designed to slow down the economy and get inflation under control. I'm going to speak about the Canadian economy right now. The number one driver of inflation is interest payments. So this is now kind of in our, central bank's control to potentially bring down inflation. However, they don't want a spending spree, and they created an immense amount of new money that might be sitting on the sidelines for whatever reason. Interest rates take money away from consumption. They go to banks who are also borrowing money at higher rates. So it's not like they'll just necessarily see insane profits because of that. We've actually seen regional banks in the States be very negatively affected by rising rates due to where they park their money in different bonds. So I think we're absolutely at peak rates, and we haven't even seen the carnage that's going to happen with the Canadian market as we're entering the first cycle of renewals. I think in January 21 is really where things had bottomed out for next basically free money and an immense amount of money just created in thin air, and they had to kind of get that tamed. So this, my vote is this is definitely peak. They haven't hinted at much else really, and they're kind of staying pat on where rates are. If you look at last year's Canadian budget, they predicted rates starting to go down around now.
Mm-hmm. Around now?
Yeah.
Interesting.
Yeah, around now. Actually, it was a little earlier, but unfortunately, just the way we're very much intertwined with the American economy, we need to kind of follow suit there. And we're in for a bigger world of hurt in Canada for sure than what they are going to experience due to our higher cost of real estate and the different way our mortgages are structured. So, Canadian central banks are going to have to do something, I think, a little bit sooner than later for sure.
Interesting.
Yeah. Well, just to
Declan, any thoughts?
one thing to take out of Pete's book there is, the number of zombie companies, as they're called, has been trending higher and quite substantially. And just like some context on that, a zombie company is a business that is not profitable. It doesn't make any organic cash flows, and so it requires financing solely to stay alive. And just adding one thing in there, so one of my favorite investors, Howard Marks, he has talked about this being a sort of sea change, and he's maybe witnessed 3 or 4 in his 50-year career as an investor. And that's because, like you said, Pete, free money money is a lot more expensive than it was in the past. And so as these businesses renew their bonds and debts, are they going to be able to sustain themselves in this new environment where it's a lot more expensive to refinance and their interest payments increase? And so that's kind of my stance on it. I've been proven time and time again wrong in terms of my expectations on the market as a whole. I definitely thought there was going to be a larger correction, but so far the market's proven a lot more resilient than I first expected. And I'm just curious, from your guys' end, is this something that you heavily factor in your investment decisions, or is it more of an important thing to take in mind, but not necessarily what dictates how you invest.
It's tough, and it's getting more difficult because the market is not as predictable. It's never been predictable. But my point is, people know that when interest rates rise, it's going to cause some pain in the economy. But the problem is, it's not like interest rates rise and then all of a sudden it's that day immediate sell-off in equities and other assets. The market is so forward-looking that by the time the central bank cuts, you've had a million, analysts on this trying to calculate the likelihood for so long that a lot of the time it's already been factored into the market. So by the time you see the outcome, it's kind of too late. Whereas now, like what Pete's saying, is if we think this is like peak interest rates, which I would have to agree, I think it seems that way. It seems like they'll start probably cutting closer to next summer. The market's already like factoring that in. So it's like you'll never really be able to act in real time. We're guessing in the future. So it's so hard to factor that kind of stuff in. Okay, give you an example. There was actually a time where bad economic news was good for the market, right? Because people say, okay, the economy is slowing down, the consumer is hurting. Oh, great. That means that the central bank is now probably more likely to cut rates rather than raise them. And due to that possibility of a rate cut, that's actually good for stocks. And then the stocks will actually rise, even though the economy was negative. So it doesn't always work like that, but it's just becoming more and more of a complication with how you want to look at these things that it's so hard to factor it in.
Mm-hmm. I agree. I think Kev, you're bang on. There's a lot of people that are looking at a lot of things that do price these things into the market. But I think inflation stuck around for a little bit longer than people expected, because typically you'll see an inverse relationship between, fixed equity bond markets and the stock market. And there's an interesting point, in late 2022 where it's just like everything was going down. I don't think everyone knew what was happening. What Kev's saying, you absolutely do see predictions in those bond yields. We could check it right now that those bond traders are very much already kind of taking bets on what's going to happen and kind of affecting those yields. But I think it's certainly something to look at. I think, post 2008, where this, our central banks kind of found a sweet spot of, deficit spending, yet keeping inflation at 2% was really impressive. For all our sakes, I hope they find a way to kind of get back to that. And I don't know if that's a pipe dream. I don't know, with the amount of money they created, if that's really possible in the short term.
Yeah. I find it easier to predict and understand microeconomics than it is macroeconomics, personally, just because, you look at a specific company like the ones that we talked about on the podcast today. How is revenue trending? Maybe you look at certain macro aspects, like is the overall economy going to support this kind of business, and like high level things of that nature. But I find it way easier to analyze the company than it is to analyze the economy. Personally, I'm better at that anyway.
Yeah. No, I share that sentiment for sure. I think the big thing is like, as someone who likes to try and figure out the valuation of a business as part of my investment process, without going too crazy into it, there's a discount rate that you apply to that valuation model, and oftentimes a lot of investors use interest rates, usually the 10-year bond yield, as their discount rate. And so again, as Kev mentioned, when those rise, usually equity valuations fall. That being said, I try to add a higher discount rate that doesn't necessarily consider that, just because there's so much fluctuation around that it's hard to predict. You don't really know. There's a lot of expectation towards where things go, but things can change in a moment, and if something unexpected happens, how will that respond?
Yep. And actually, hey man, I'm glad you brought that up, because I completely forgot. So obviously, yeah, when bond rates get higher, they're more attractive than equities comparatively. Money moves over. But just like you said, with the discount cash flow, like if you're looking at a company that makes $10 million free cash flow every single year, and you think that it will for the next 10 years, obviously $10 million in 10 years is not worth as much to you as $10 million today, because that money today you can reinvest, and then in 10 years it's worth more than 10 million. So just like you said, how you discount what is that $10 million in the future, what's that worth today? Just like you said, you look at their discount rate, which there's the risk-free rate. Oh man, this is CFA coming back to me. It's blurry, but there's the risk-free rate, which like you said, it's the treasury bond yield. And then you add like an equity risk premium. So obviously when interest rates are higher and higher and higher, you now discount these future cash flows a lot more. So that $10 million today, or yes, in 10 years, maybe it used to be worth $8 million today, it's worth $4 million now. So now that company's current value is less. So that's something super critical that I completely missed. So Mr. Fundamentals, one check for you, my friend.
Appreciate it.
Well then, my friends, let's go into our discussion around a stock. Mr. Trend Tracker, you brought that to the table. Nuvei Corporation, you want to give us a little run through on what this company is all about?
Yeah, they're in the payment space, guys, and I think this is something that we should absolutely pay attention to. If there's any type of growing company in the payment space, it's something we should all watch, especially if it's fitting under kind of our 10 billion market cap watch list. This is a Canadian company that's expanding globally right now in the payment space. So for you guys, watching at home, these are people that the core of their business model is making, basis points off of primarily credit card transactions. However, that's maybe how they started, but they've expanded to, digital payments in a lot of different ways. They're working potentially in crypto as well. They're creating suites of products and integration. So what's really interesting about this is, let's say you're paying for something and maybe you're at a local restaurant. So you swipe your credit card. What happens after the fact? Well, I think if you guys have noticed, sometimes they're giving you that and it's right there. That is integrating with their point of sale system. That might be integrating with their, inventory system, a lot of things. And these integrations in business are becoming incredibly more vital for reporting as your business grows, to give you better insights into your business. And they're making, potentially, fractions off of that. But as, the economy hopefully kind of recovers and ends up in a great place and more consumption is going up, they will be making more fractions of more transactions. And what I really like about these guys is where they're growing kind of in the Middle East and Africa. These are countries that are showing more credit card adoption as well. And, we are moving towards a cashless society. And if you're part of that money printing machine, as you're getting money to flow in because of consumer spending, that's something that's really interesting to me. These guys had kind of had a big peak during the overall bull run in 2021. But what's funny is, though their stock has gone down, their user base is growing. And this is a growing company that's kind of getting beat up a little bit over maybe taking money at a high valuation during a bull run. So I really like what they're doing, and I'm happy to kind of go into some more metrics about them. But they're really interesting, and this is something that we should all pay attention to.
Okay, interesting. This is one that I haven't had enough time to dig into. As you can see here, I've been preoccupied in the emergency room this week. But I like the payment space for sure. 4.5 billion market cap doesn't seem too unreasonable for a company that's pushing $1 billion, getting up to $1 billion in revenue. It looks like this year they might actually be over $1 billion, so it's not a crazy premium on revenue for a growing company. Do these guys rely on credit cards, or is there any kind of non-credit card digital payment option?
So they're creating a big suite, but usually the moneymaker for a lot of these guys is credit card transactions, because you are assuming some risk. Right? There is risk of chargebacks, but that is actually built into the pricing model. The odds of a chargeback happening or something along those lines are applied. So card not present transactions, you not swiping it, are higher fraud risk. So you're paying more. But people are paying businesses more and more. You're getting invoices as a B2B business with the option to pay credit card. And, a lot of people are getting really into points and are willing to potentially keep a hotel status or an airline status and maybe lose a little bit on some transaction fees. So you're seeing that. And yeah, they absolutely rely on credit cards as a bread and butter, but they work in EFTs, they work in debit transactions. They can make money off of terminals. They can do a lot of different interesting things as revenue drivers for your business, and then eventually become potentially a credit facility themselves as you're growing more and more users.
Interesting. Yeah.
Interesting, because what I'd be curious about is you look at growth regions like Africa, for example, and they actually prevalence of cell phone use is exceptionally high, which maybe a surprise to some people, but they didn't have a lot of this landline infrastructure. So going straight to, like having an internet-enabled phone was actually quite popular. So that's why crypto for payments boomed, because a lot of people did have a cell phone with internet connection, but they didn't have a traditional bank account because they either typically they just weren't qualified for them. So you see these crypto transactions take off. So I'd be super curious to see a company like this weasel their way into that market, possibly without Visa, where these patrons wouldn't qualify for a Visa, maybe couldn't get a credit card, but could still utilize the payment system. So that's just a bit of an aside, but I'd be curious to see how a company like this would fit into something like that.
Mm-hmm. Guys, I think I also have to express probably the biggest factor for success. They have Ryan Reynolds as one of their ambassadors here.
Okay, I'm in.
Guys, it's a home run. You guys seen his content for Aviation Gin? Yes. The guy doesn't miss. All right. Yeah. He succeeded at a soccer club in the UK. Come on, guys.
Yeah. Great show too. Wow.
This thing, if that's not bullish, I don't know what is. But I think something I kind of want you guys to see is that, again, if we believe that in terms of interest that you have to get people kind of to your website, especially a business like this. People are going to want to see what you're doing. I think let's take a quick peek of what's going on. And I think when we take a look here, we can see the stock itself was, had a really high peak. They had done really big financings with a lot of institutional investors behind them. They had some really big names. And, it had, in today's terms, had a $163 a share peak, and they're down to $32. Wow. But when I look at this, their user base and their interest is going the right way. Yeah. So what was priced in before might not be there now. And when I look at some of their institutional holdings, I've seen BlackRock take a really big stake in them. And you can kind of see that here. And I went back and kind of looked at everything on their end, and Vanguard's been holding. Guys, Vanguard, who's a big shareholder here, and BlackRock actually just took like a fairly large position in the last quarter. So these guys are here. They really haven't really changed this position, and these guys bought at the higher end of it and are holding. I think a lot of these institutional guys really believe in this digital payment space as well.
Yeah, no, I will give them credit that I see they just swung to net profit. So earnings per share. I'm looking at Yahoo Finance on the fly here, so let's just take it with a grain of salt. That's not always right, but it says 40 cents earnings per share last year in 2022. If you use the current share price of $32, that's like an 81 times. So it's not cheap, certainly. So the market's expecting continued growth, which, again, in their defense, they have shown. I mean, they've grown, $245 million in 2019 to $843 million in 2022. Like, that's obviously... that's solid with good gross margins. So they're just going to have to continue to deliver on that in order to justify that valuation.
Yeah, and I'll comment on that actually. In the private space, there's a lot of private brokers or people who build books of business. Guys, what you have to imagine, this is a residual type business. This is a big change for certain companies, right? They're not changing every month. You are getting a portion of their top line revenue on their spending to your bank account with very little variable costs. The costs are getting new customers. So I think also in the private space, these companies actually sell privately for 30 times earnings.
Right.
Interesting.
Yeah. Mm-hmm. Yeah. So the valuation is justifiable from that end anyways. And just another point to bring up just on ownership. I did notice when I was looking into the company that the founder owns about 20% of the company himself. And so in that case, like that's a lot of conviction behind the business as well. And I guess like my big thing, Pete, that I'm curious about is, what differentiates Nuvei from other payment processing platforms like a PayPal or a Stripe or a Square? What do you think separates them and is going to be able to make that long-term sustainable advantage?
They are really growing their integration network, and that is huge. As a business owner myself, I understand that and the pain that you can feel by certain things not integrating. And that's something that they're actually spending a lot of focus on. And they commented that on their kind of recent shareholder information and earnings report. So I think that's really interesting. And, I think being a more of a one-stop shop is really helpful, where Stripe is really focused on card not present, having a really easy to use API. Stripe's great for, a lot of online businesses, but what if you're an online business with a brick and mortar solution? Now Stripe's trying to get in that. They're valued a heck of a lot more than $4 billion right now. So, I think that kind of gives a case for the overall industry. And then what can you expand on once you get a user? So if you're offering a bigger suite of products, I think that is, that point of differentiation where, Stripe really isn't doing too much of that yet.
Let's see what Stripe is. Is Stripe still private? Oh, they are.
They're still private, yeah.
Still private.
I think they may have done a down round, but they
would have. Yeah, fintech's been hit pretty hard.
Don't quote me, but I think they may have done one round at 50 billion.
Jesus. Okay. Interesting. I'd be curious.
Let's check that. We might need to cut that out, guys, if I'm wrong.
That's okay. One thing that interests me. So I remember
wow, guys, nailed it. March 15th. Stripe now valued at $50 billion following $6.5 billion raise. So
back when? Sorry?
March 15th, 2023. Not a great time to be raising money.
No.
Got a $50 billion private valuation. So.
Oh, interesting. I'm curious what it was before, but that's certainly hefty. I wonder how that compares to this. Maybe we can dig into that after and follow up with it.
Yeah.
When I rewind and go back in the day to when I was an analyst and looking at Canadian equities, let me use pipelines as an example, looking at Trans-Canada Pipeline and then looking at Enbridge Pipeline. This is like 10 years ago. So Enbridge, if I recall correctly, was trading at a much higher price to earnings than Trans-Canada. And the reason being that their contracts were so much better. They were longer term, better agreements in the case of non-payment, et cetera, et cetera, et cetera. What I'm saying is the market was very willing to pay for long-term stability. So what I wonder is a company like this, fine, maybe they have an 80, 81 times price to earnings, but if their contracts and their payment terms, just like you said, if this is going to add significant ARR and the contracts over the next 10 to 20 years, well, fine, you're comfortable paying a high premium for that kind of long-term stability, and their margins are pretty killer. So I could see a path to where they would be able to justify a higher valuation. So yeah, I wouldn't hold that against them.
Yeah.
Yeah, that's true. And they just actually announced a fairly large partnership with Microsoft as well.
Nice.
Yeah, and even one more point on that too. I did find out that the company acquired another payment platform. I'm not sure if it's international or not, but called Paya for $1.2 billion. So well above the company's current valuation. So perhaps that's why the PE is being factored in as well, as they've acquired a company that is larger than them, and how that will translate down the road into growth. So perhaps another reason anyways from my end.
Cool. It is one of the fastest ways to grow in this industry is through acquisition as well. Sure.
Well, and then one of the best parts of having a high valuation, like a high price to earnings, is that it's so much easier to make any acquisition accretive to your earnings per share if you already have such a high price to earnings multiple. So when you generally see companies, when their multiple starts to jump up, you see the likelihood and the appetite for acquisitions jumping up as well. And those are very shareholder friendly acquisitions too. So I'm curious to dig into the terms of this latest one to see what that looks like.
Yeah. Overall, pretty
Nuvei.
Impressed with the business. So it's something that I'm going to keep on my watch list. But they've done a lot well, and they have a pretty strong balance sheet, and we'll see if the valuation is realized. But overall, quite impressive.
Yeah, it is. Pete, do you own it now, or are you looking to buy it? What do you think?
I do not, actually. I think this was a good inspiration for me to do a little bit of digging. And I think this is something that I'm going to look into a little bit more seriously about taking a bigger position.
Yeah, I like it. It's right in our sweet spot, and we like that.
Yeah, absolutely.
Okay, guys. Well, hey, we've covered a lot of stuff. We blasted through the Sunday snapshot topics. We had a chance to do a little educational series on rising interest rates, and we had a stock pitch of Nuvei Corp. So I think this was a pretty meaty podcast. Why don't we wind it down there? To everyone listening, this is episode 2, Beyond the Edge podcast. filmed every Thursday, released every Sunday. You've got Kevin, Declan, and Peter. Next week, we may have some guests for you. Let's see. But thanks, guys, for tuning in. Thank you, gentlemen, for sharing this time with me. Appreciate it.
Yeah,
Thanks
thank
so
you.
much, guys.
Appreciate it.
All right, over and out.
All right.